To say good morning to everybody who is joining us this morning for the 2025 legislative session overview. I wanted to go over a few items just real quickly before we get started. We know that the 2025 session had a lot of different bills, and some of which were extremely large and had a lot of different topics in them. We know that we've gotten a majority of our legislative guidance memos out, but the department had always originally planned to have some follow-up FAQ documents based on additional questions that we received, as well as questions that were provided during the webinar presentations or in advance of the webinar presentations. So please feel free to, as Jenny mentioned at the beginning, put your questions into the chat for this webinar presentation, as well as contacting either your assessment or budget field rep if it's applicable, or contacting our office with questions that we can consider for future FAQ documents. I will say that a lot of questions that we have been receiving have been, how will this bill impact, our unit? And for some of the bills, the bills are several hundred pages long. And so to provide good guidance and to give the most accurate or useful information, it'll be important for anybody that has a question to make sure that it is tailored to a specific part of a bill or topic. Not necessarily the bill in its entirety. And the department would also remind local units that looking at fiscal projections of how something will impact their unit of government, 1, 2, 3, 4 years in the future, is not really a service or a function of the department. And we would encourage all units that want to know what this could potentially do to the units for, revenues and budgets in the future. Look to additional external resources, whether it's the projected fiscal impact statement that's associated with the legislation, or working with local resources to kind of look in the future to see what this could or could not do to a local unit. Again, I'm joined this morning with my colleagues, David Marusars and Stephen Lucas. And for this morning's presentation, we're going to be doing something a little different from previous years where we've done legislative overviews. This is just our typical disclaimer slide, just reminding everybody that this presentation is meant to give you some additional context, some additional information, try to connect some pieces, but it's not legal advice, and this is never something that should be a substitute for reading the Indiana Code. We are really diligent in our presentations, particularly these presentations, of noting at the bottom of most all slides, both the Indiana Code citation as well as the section of the bill that is being referenced, so that individuals can go and look at the material directly to see what the law says. So as I mentioned, this will be a little different from some of our previous legislative update presentations where in the past, like most of our webinars, we provide the same content in both the morning and the afternoon session. Because of the scope and volume of items that passed during the 2025 session, and to ensure that we can be as comprehensive as possible in our presentations, we will be covering one set of topics this morning, which are projected on the screen, and then this afternoon we'll be covering another set of topics. This morning's agenda will include items that relate to assessment matters, deductions, exemptions, and credits, and the property tax deferral program. This afternoon we'll focus on local budgeting matters, local income taxes, referenda, controlled projects, charter sharing revenue options, and a few other items that were just kind of miscellaneous related to budgeting specific areas. So at this time, we're going to go ahead and move on to our first topic, which is assessment matters, and I will turn it over to Stephen.
Thank you, Emily. Good morning, everyone. My name is Stephen Lucas. I'm going to be discussing some of the legislative changes that affected assessment matters. And before I get into the details, I just wanted to mention that, as Emily mentioned, there were a couple of large bills that passed that touched on different areas of local government finance. We're going to be referencing Senate Enrolled Act 1 and House Enrolled Act 1427 quite a bit, both this morning and this afternoon. These were two very large kind of omnibus bills. And I wanted to mention the dates that each was signed by the governor. Senate Enrolled Act 1 was signed by the governor on April 15th. And 3 weeks later, House Enrolled Act 1427 was signed on May 6th. And I wanted to mention those dates because some of the changes enacted in Senate Enrolled Act 1 were then modified, or in some cases undone, by House Enrolled Act 1427. So if you are reviewing legislation yourself, in particular Senate Enrolled Act 1, please keep in mind that particular sections of that bill may have been modified or even removed by subsequent legislation. As Emily mentioned, our slides should include references to the particular sections of the bill, so just keep in mind any follow-up legislation that may have impacted those areas. And the first topic I'm going to cover is actually one of those items that was amended in Senate Enrolled Act 1 and then further amended in House Enrolled Act 1427. This is the increase to the business personal property exemption amount. Under previous law, a taxpayer with a business personal property acquisition cost in a county of less than $80,000 was exempt from paying personal property taxes. Both of the bills mentioned increased this amount. However, the increase for the 2025 assessment date that was in Senate Enrolled Act 1 was then undone in House Enrolled Act 1427. So effectively, what we are left with is that the exemption amount threshold has been increased to $2 million as of the January 1, 2026 assessment date. So starting with January 1 next year, a taxpayer with a business personal property acquisition cost of less than $2 million in a county will be exempt from personal property taxation. This will function very close to how filings function now. If a taxpayer is now exempt or will be exempt as of next year, but has never claimed the exemption, they will need to file a personal property return one more time to claim the exemption. And then the provision that is under Indiana Code 6, 1.137.2, subsection F, that says a filer doesn't need to refile in subsequent years if they continue to qualify for the exemption, that will still apply. Now, I mentioned that for a brief period of time, the exemption amount was raised to $1 million as of or for the January 1, 2025 assessment date. So it could be the case that a taxpayer between April 15th and May 6th filed a return and said that they were exempt from taxation because they had an acquisition cost in a county of less than $1 million, but more than the $80,000 amount that previously was in law. If a taxpayer falls into this category, they were supposed to have filed an amended personal property tax return by May 31st. It's possible that taxpayers who should have filed an amended return didn't realize that they should have. So in that case, assessors should reject the portion of the claimed exemption that the taxpayer was ineligible for and should notify the taxpayer accordingly. So the next change I will go over, again, was also put in place by Senate Enrolled Act 1 and then modified by House Enrolled Act 1427. This applies to these changes affected the 30% minimum valuation limitation, which is often called the 30% floor, that applies to depreciable personal property. At the end of the day, the changes that made it into law are that depreciable personal property placed in service after January 1, 2025 will only be subject to the 30% floor if it is situated within an existing tax increment allocation area where the base AV was established prior to January 1, 2025. So for all other business personal property placed in service after January 1, 2025, it will no longer be subject to the 30% floor. They included this carve out for property in existing TIF districts, I believe, to protect TIFs, but other property, assuming no other laws or regulations apply, can depreciate below that 30% floor. We will be updating our personal property tax return forms to reflect both the increase of the exemption amount and the removal of the 30% floor to help facilitate implementation of these changes. And as I mentioned, personal property tax return filing, that's a nice segue into a change to the personal property online portal. You may have seen that that pop-in will be discontinued and no new filings will be accepted after this year. Essentially, House Enrolled Act 1427 removed provisions that required the department to establish and provide that service. So as of next year, no new filings will be accepted. I will note that the department is planning to ensure that filers who have data on Pop-in will be able to access and download that data into the future. We are still working on those details, so we will provide more information once we have it. The next change is one that hopefully you have seen and implemented already, if this applies to you. This was a change to the agricultural land base rate. Again, both Senate Enrolled Act 1 and House Enrolled Act 1427 touched on this. At the end of the day, the change included an increase to a capitalization rate that was part of the department's calculation in coming up with the base rate. That increased a rate from 8% to 9%, which had the effect of lowering the agricultural land base rate for both the 2025 assessment date, and it will apply for the 2026 assessment date. I'll just note that the modified base rate for the 2025 assessment date does not apply to land assessed under Indiana Code 6 1.1412, which is often referred to as the developer's discount. The department had already issued its ag land base rate memo for 2025 prior to the session starting. And so after the session ended and this change was included in law, the department had to issue a revised, both a revised base rate, which as you can see is $2,120, and also a revised memo that was issued on May 9th. You can refer to that memo for additional details if you want. But assessors have hopefully seen that and should have used that revised base rate for agricultural land. And if they had already rolled and balanced their values, have hopefully updated the values and then re-rolled and balanced with the revised rate. So if you have any questions, I would refer you first to our May 9th memo. And then if that doesn't answer your questions, feel free to reach out to your field reps or the department. Some of the next changes I will mention may not be as impactful, but I still want to go over them because they may apply to your county. House Enrolled Act 1427 updated the definition of qualifying county in a chapter of code that spells out which counties and which industrial facilities are subject to the department's assessment. So these are large industrial facilities located in qualifying counties. A qualifying county was defined by reference to a population range that was 400,000 to 700,000 individuals. The lower bound of that range was updated by House Enrolled Act 1427 to now be 450,000 to 700,000. At the end of the day, this means that Lake County was and is still the only qualifying county that falls under this chapter of code. Now, the first bill that's not Senate Enrolled Act 1 or House Enrolled Act 1427 that I will mention is Senate Enrolled Act 187, which made a minor but important update to the membership requirements for property tax assessment boards of appeal. This bill says that a member of a PETA-BOA must be a resident of Indiana for the entirety of that member's term. So this hopefully won't affect most counties, but especially if you are a county near the border of the state, you might want to make sure that your PETA-BOA members meet this new requirement. The bill says that if there is a current PETA-BOA member who is not a resident of Indiana, that member's term now expires July 1st, 2025, and the vacancy, if there is one, would be filled by the relevant appointing authority charged with appointing the member in the first place. I know there was at least one county that this did apply to. There may be more, so please take a look at your membership and see if this impacts you. Another clarification to PETA-BOA membership requirements was included in House Enrolled Act 1427. This was a minor clarification that said that the terms for members are for 2 years and must be staggered. Previously, I don't believe the statute included a specific or an explicit reference to the length of the term. It did say the terms had to be staggered, but now the law explicitly says that the terms are to be for 2 years. Another update included in House Enrolled Act 1427 that hopefully won't be that widespread, although it is a process that the department has engaged with more in recent years, is a process for a review of the land values determined by an assessor. Those are often called land orders. Indiana code provides that taxpayers can petition the department for a review of those land orders under the statute shown on the screen. The changes under House Enrolled Act 1427 include that those petitions, assuming they meet the required number of signatures, will now be submitted to the county auditors instead of directly to the department. And those petitions are now required to include a bit more information. The bill says that the petition must set forth the property owner's objections to the land order included with the signatures. Auditors will then take those petitions and certify that they meet the statutory requirements, send the petitions to the department, along with any other data necessary to present the property owner's objections to the department. I believe these changes were meant to help provide the department all the information necessary to conduct its review should one of these petitions be filed. The department will still be required to hold a public hearing should it receive one of these petitions. Previously, the statute did not provide any specific notice requirement ahead of the department holding a public hearing. And so House Enrolled Act 1427 adds an explicit notice requirement that the department provide the first 10 petition signatories notice of the hearing at least 5 days before the hearing is held. So the department will at least meet that new requirement, if not greater notice. And now I will turn things back over to Emily.
Thank you, Stephen. So the next item we have is related to community land trust assessments. So under 1427, there were two areas that related to community land trust for assessments. They specified a different, or a very prescribed method for the assessment of both land and improvements for community land trust property. As specified in section 21 of the bill, it specifies the assessed value of land that is held by a community land trust is equal to the assessed value of the land at the time it was acquired by the community land trust. And then after the initial assessment, it specifies that the assessed value of the improvements may not exceed the maximum amount for which the community land trust improvement can be sold or transferred, which is set forth in the affordability restrictions of the ground lease. So what's important for this area is that there's a lot of terms that are defined. Knowing what does it mean to be a community land trust, what is the improvement that is owned by a community land trust, what are the affordability restrictions, and what is a ground lease. And so some of those definitions are all defined within both the statute that's referenced in the first bullet point of the slide, and it is also referenced in the memo that we released. So I'll go over a few of them this morning just to give some more context. A community land trust is defined to mean a nonprofit corporation that meets the following requirements. It's a nonprofit corporation that's exempt from taxation, and there's a 501c3 for the Internal Revenue Services. The primary purpose of the nonprofit is the creation and maintenance of permanently affordable single-family or multifamily residence. And 3, the nonprofit corporation leases community land trust land on which the community land trust improvement or structure is located. And then it's important to know who is a qualified owner. And a qualified owner is also defined to mean that it's an individual who's a member of a household with the annual income that is not more than 80% of the median household income in a community land trust land surrounding area, as determined according to the median household income amounts published by the U.S. Department of Housing and Urban Development. Those are two of the big key definitions. The definition of land and improvements is relatively similar to what we are accustomed to seeing for land and improvements. And the affordability restrictions provisions are also outlined in the statute, which will be relevant for purposes of reviewing a ground lease, which is a lease that's entered into by the community land trust and the qualified owner of the property at issue. The lease should include terms like affordability restrictions, restrictions for resale or transfer of the property, provision that's stating the community land trust retains an interest of the land underneath the improvements, the initial appraised value of the community land trust improvement, a monthly fee the qualified owner must pay, land trust for the land, and that the term is not to exceed 99 years that may be renewed. So those will all be things that are important. As we noted in the next slide, that assessors are going to need to perform a certain amount of due diligence to collect additional information for these properties. At this time, I don't believe there is a ton of properties that this is going to impact, but it might be something that there's an increased amount of them that kind of pop up around the state. So it'll be important to collect different data points as well as copies of the ground lease to ensure they can evaluate the terms of the ground lease for when they're looking at improvement values for any dates after the initial assessment date. The department will be issuing future guidance on how to classify properties that are owned by community land trust within the local assessment software. It could be something, whether it's a different adjustment code type or something like a property class code. But we will also be including guidance in that additional memo about the additional application of the adjustment factors for the improvements. So that information will be forthcoming, and it will be in addition to potentially the property class code changes that we released at the time of the memo for the deductions, exemptions, and credits. The next item relates to solar land base rate, and this is also under House Enrolled Act 1427. In years past, language was added to the code specifying that the department by December 1st of each year will calculate and release the solar land base rate for the northern region, the central region, and the southern region of the state. After having a few years of looking at that data, there was some questions about, why are potentially some regions drastically different than others? And I think the South region was one that was a little bit different from the Central and the North region. So in evaluating those values, some of the legislators were looking at, why some of the values might have been lower in the Southern region. And looking at the data a little bit further, it was identified that some of the properties were using the property class code, which is specifically outlined in statute to identify utility property, which is the basis for determining the median value of land in a specific region of the county. Even though they had that 800 series utility property class code, the property was being assessed using the ag land base rate, which showed that it was probably being used for a purpose that was different from the property class code. So the clarification here is just meant to further hone and target those properties that are both owned by a utility and being used for the purpose. So this specifies that beginning with the next year that we'll be calculating and releasing the solar land base rate that would be applicable for the following year. The department is to exclude any values that are used, any property class code values that are using the agricultural land base rate from the calculation that is done. Next, we'll touch on state distributable property. This is utility-based property that is crossing county lines that is submitted to the department. Currently in statute, it specifies that the public utility company that is self-reporting or providing the assessment returns to the department, they have 10 days after receiving the department's preliminary or tentative assessment to object or request a conference to discuss a correction or desired change. With this statutory change, it now specifies that the property owner, the public utility company, has 15 days from the date that the department sends notice of the tentative assessment. So it's giving an additional 5 days. And the last item under assessment matters just relates to a brief technical update regarding filings with the Indiana Board of Tax Review. As the IBTR created and developed and has launched their online filing system, there was just a slight tweak to the language in several different statutes that says served or filed as opposed to mailed, which would allow for the mailing through U.S. mail or using the electronic filing system. Next, we're going to cover deductions, exemptions, and credits. And before I turn it over to Stephen, I will make one note. We have received a number of inquiries about deduction forms, either it's new ones or new credit forms that are needed based on the effective date of some of the bills and sections of the bills that Stephen will get into in the next couple of slides. The department is actively and diligently working to both modify existing forms, to kind of transition some of them into credit forms, as well as deactivating forms that are for deductions that, based on the effective date of statute, are no longer available to taxpayers. They're also in the process of updating the property tax benefits form, which is that summary form that tends to be a pretty good guide or quick sheet for taxpayers and local officials and has to be provided by closing agents for certain conveyances of property. We are also working to develop new forms for new credits that do not currently exist. We'll go over each of those in a little bit more detail in the coming slides, but our memo does state for some of those that were previously deductions and credits that a number of counties have identified that they are looking to just roll individuals that were previously receiving the deduction into the credit. So that is one thing that we would just encourage all counties to consider, whether that's a practice they plan to utilize for this or if they plan to do something a little bit different. So at this time, I will turn it over to Stephen.
Thank you, Emily. So I'll dive right in. Senate Enrolled Act 1 converted both the over 65 deduction and the blind or disabled deduction that previously existed to credits. So the deductions were eliminated, new credits were added in their place, and you can see that the over 65 credit amount is $150. The blind or disabled credit amount is $125. These will first apply for the 2025 pay 2026 cycle. The credits will be applied to a qualifying individual's tax liability after the application of any tax cap credits, but before the application of any other credits under Indiana Code 6-1.1 or 6-3.6. We have included a slide a bit later on in the presentation that shows an example, kind of the order of operations of both deductions and some of the new credits to hopefully give you a bit of sense of how these will work in practice. And as Emily mentioned, counties should consider automatically transferring those individuals who had been receiving the deduction over to the new credits in both the over 65 credit and the case of the blind or disabled credit. The qualifications have been updated, and I'll go over those here in a second, but they have been sort of made less restrictive. So anyone who qualified for the deductions should qualify for the credits. And so for that reason, to avoid forcing folks to come in to reapply for the credits, counties may want to just automatically convert them over to those credits. So for the over 65 credit that is replacing the deduction, some of the changes include an increase to the income limits. The credit now has an income limit of $60,000 for an individual, or $70,000 for a married individual, or someone who owns property jointly as a joint tenant or tenants in common. Unlike the deduction, the statute does not provide for an automatic increase to these income limits based on the Social Security cost of living adjustments. So for the time being, unless the legislature changes that, those amounts will remain static, and the department will no longer be including an adjustment for this credit in its annual memo that we put out. I'll talk about the over 65 circuit breaker credit here shortly. Another change to the credit requirements, well, several changes. The previous requirement that the applicant be a resident of the property was removed for the credit. The limit on the assessed value of the property was removed. And then previously, the over 65 deduction had restrictions on what other deductions the applicant could claim at the same time. Those restrictions have been removed for the credit. So again, Emily mentioned we'll be updating our property tax benefits form. That's the form that lists all the different eligibility requirements, the application form that folks will have to use, any applicable restrictions, the maximum amount. So that form will be a good resource to see all of these changes in one place. And then again, as we update our particular application forms, you'll be able to see these requirements in a bit more detail as well. Fewer changes to the blind or disabled credit. Essentially, the only change was the elimination of the income limit. So folks who otherwise qualify for this credit no longer have to earn below a certain income amount. Otherwise, the eligibility requirements for the credit are the same as the deduction. I mentioned there were some changes to the over 65 circuit breaker credit. Senate Enrolled Act 1 modified some of the eligibility requirements. It increased, similar to the over 65 credit, it increased the income amounts to $60,000 and $70,000. However, for the over 65 circuit breaker credit, those amounts will still be subject to an annual adjustment based on the Social Security COLA increases. So the department will still be releasing a memo annually to announce what those amounts have been adjusted to. You should look for that later this year. But for the 2025 pay 2026 tax year, you can use the amounts of $60,000 and $70,000. Another change to the circuit breaker credit was the removal of the limit on the assessed value of the property. Previously, that limit had been set at $240,000. We've included a slide covering the veterans deductions here, or two deductions for veterans, simply to head off any possible confusion. This is another case where there were changes made under Senate Enrolled Act 1 that were then undone by House Enrolled Act 1427. So both the common deductions for veterans, the total and the partial, as they're commonly called, were briefly converted to credits under Senate Enrolled Act 1, but that conversion was then undone and the deductions were put back in place under House Enrolled Act 1427. So at the end of the day, these two deductions effectively emerge unchanged from the recent legislative session. But we wanted to mention that in case you see any news articles or read anything that talks about these being converted to credits. That was the case for a few weeks, and now they're back to deductions. Emily mentioned that there were several deductions eliminated by Senate Enrolled Act 1 that we are in the process of removing from our website. Most of those deductions include environmental related deductions. We've included a list of the deductions that were sunset under Senate Enrolled Act 1. We've included a citation to the Indiana Code that provided for these deductions, and then again, the section of Senate Enrolled Act 1 that made the applicable change. So you can take a look on your own as to which deductions were removed, but again, these will all be reflected in the department's forms as we're working through our updates. I do want to mention, simply because we've had a few questions, the last item on this list, deduction for personal property held as inventory. That was a deduction that applied for, I believe, the 2006 pay 2007 tax year only. That really shouldn't have much of a practical impact. We've had some folks reaching out asking whether that applies to mobile homes. That deduction essentially has sort of been inactive for some time, and I think removing it here in Senate Enrolled Act 1 was just a cleanup action, so that shouldn't really have much of an impact. So the next two slides detail both a phase out of the standard homestead deduction amount and a phase in or a gradual increase to the supplemental homestead deduction percentage. Senate Enrolled Act 1 provides that the homestead standard deduction amount will go down over the next 5 or 6 years. For the 2025 assessment date, for pay 2026, the amount is set at $48,000 as opposed to the lesser of 60% of the AV or $48,000. So it's just $48,000. And then the amount starts to go down over the next 5 years. The amount will hit zero as of the 2030 assessment date for pay 2031. However, the bill, Senate Enrolled Act 1, did not eliminate the deduction. It just zeroes out the amount. I believe that's because there are several things tied to a person receiving a standard homestead deduction. So they will receive the deduction, but the amount of the deduction will be $0. And in its place, Senate Enrolled Act 1 provides for a gradual increase to the percentage for the supplemental homestead deduction percentage. You can see what those percentages are for the next several years before it tops out at 66.7% for pay 31, and then each year thereafter. Senate Enrolled Act 1 also provided that the deduction amount, the supplemental homestead deduction amount, can't exceed 75% of the gross AV of the property. This slide is just a note that Senate Enrolled Act 1 included direction to the department to make certain adjustments to TIF areas to neutralize the possible impact of the changes to the homestead standard deduction, the supplemental homestead deduction, and then a new deduction for 2% circuit breaker properties that I'll talk about here in just a second. But essentially, as a result of the changes to those deductions, the department is to neutralize the effect of any change in tax rates or TIFs. Essentially, the TIF doesn't stand to benefit from these changes. The benefit, if any, will go to the base AV, although I do believe the department is empowered to, if the opposite were to happen, protect the ability of TIFs to cover their debts. So just a note here. As I referenced, there is a new deduction available for 2% circuit breaker properties. This was a new section of code added, and it covers eligible properties as defined in the statute. This means property subject to the 2% circuit breaker credit under the relevant statute, which includes non-homestead residential property, long-term care property, and agricultural land. This is a deduction that auditors are required to simply apply to eligible properties. Property owners do not need to fill out an application to receive this deduction. And here's a table showing the amount of the deduction for the next 5 years. Again, this will gradually increase and top out at 33.4% of the AV. Another new benefit for taxpayers is a supplemental homestead credit. This was added by Senate Enrolled Act 1 and applies to property taxes due and payable starting in 2026. This bill provides that anyone who qualifies for the standard homestead deduction or who's married at the time of death to a deceased spouse who qualifies is entitled to this new credit. Again, this is a benefit that taxpayers, property owners are not required to apply for. Auditors are charged with identifying eligible properties and applying the credit to their tax liability. The amount of this credit is either $300 or 1/10 of the property tax liability for the year, whichever is less. Now, as I alluded to earlier, the department I've got an example of how deductions and credits are to be applied in order. As a general rule, though, exemptions are applied first, followed by deductions. And then once you reach your tax liability, credits are applied to that. If there is a specific statute that specifies in what order or how a deduction or a credit is to be applied, the statute should always be followed. I'll also note that there is a code citation here that I've included that talks about providing a taxpayer when the deduction or exemption amount isn't applied to or isn't specific to an improvement. Those deductions or exemptions are to be applied in a way that will maximize the benefit of that deduction or exemption to the taxpayer. So that's also the department's guidance when the order isn't clear or it's not specific to an improvement, apply the deduction or the exemption or the credit in the way that will most benefit the taxpayer. But here we have spelled out an example based on a gross assessed value of $500,000. You can see how the standard homestead deduction amount, the supplemental homestead deduction amount are applied. In this case, we've included the deductions that are available to veterans, as a person could qualify for both of those. Those deductions taken off yield your net assessed value, which divided by 100 multiplied by your tax rate gets you to your gross property tax liability that you apply credits to. The new over 65 credit and the blind and disabled credit, as I mentioned earlier, those are to be applied before any other credits. under 6.1.1 or 6.3.6. So you'll see those first. The new supplemental homestead credit of $300 or a tenth of your property tax liability gets applied to that. If a person qualifies for the over 65 circuit breaker credit, that will be applied next. And then we've included a new homestead property tax replacement credit that we will be discussing, I believe, in our afternoon session as the last item here. So this is hopefully a helpful reference to see how this might all work in practice. And I believe the last slide I'm going to discuss is a minor change to certified technology parks. Senate Enrolled Act 516 basically swapped out certain duties that were assigned to the IEDC, the Indiana Economic Development Corporation, and gave those duties to a new Office of Entrepreneurship and Innovation. One of those duties that was transferred was review of ordinances granting a deduction under Indiana Code 6, 1.1, 12.7 4A. That statute, I believe, includes sort of a phase out of the deduction. So this may not be all that applicable, but we've mentioned it here just in case folks are impacted. And I believe I will turn things back over to Emily now.
Thank you, Stephen. I'm going to continue with the subject of community land trust property. So in addition to the assessment changes that were referenced earlier in the presentation, the legislation under House Enrolled Act 1427 also provided for a property tax credit for community land trust property. It specifies that a qualified owner whose property is assessed under the referenced statute is entitled to a property tax credit equal to 30% of the net property taxes due. This credit would be first applicable to assessment dates occurring after December 31st of 2025. Now, the statute does not currently identify which local official is supposed to receive a credit application. However, it does specify that an application has to be completed and filled out and filed with the local applicable county. The department has been tasked with prescribing this application form. And we are in the process of finalizing the draft of that form at this time. Until there is additional legislative guidance or clarification as to who this application form should be provided to, the department's current working draft of the application is defaulting to how other similar credits are filed with the county, and that directs the applications to go to the county auditor. The next one we're going to go into is we're going to kind of cover the bucket of exemptions. I'm going to kind of quickly go over some of these. There's additional information for these provided within our guidance memos. The first one that we're going to go over is the early childhood education centers. This is an exemption that was originally added to Indiana Code in 2014 and later amended in 2018. Under House Enrolled Act 1427, it specifies that as of January 1, 2026, for-profit providers of early childhood education services for children under the age of 6 may receive the exemption as outlined in 6-1.110-16 for property that is used for educational purposes if the requirements under the section of code that is more specific to early childhood education centers are met. Prior to this change, the exemption was only available for providers of early childhood education services for children who are at least 4 but less than 6. If a qualified taxpayer provided services to children under the age of 4, the exemption was prorated based on the number of qualified children as compared to the total number of children that receive services at the property. So kind of in sum total, the bill makes the following changes for both the amount of the exemption as well as the qualifications to receive the exemption. The primary purpose of the provider no longer has to be just educational. The property may be owned by the provider or a parent company, subsidiary, or an affiliate company of the provider. The property must be predominantly used instead of solely used to provide services to children of any age under the age of 6. And the provider must offer age-appropriate curriculum, including reading for children under the age of 6. The exemption will not be prorated for providers that are serving children that are under the ages of 4, and it does not apply to homestead property. This will be a relevant distinction for potentially a daycare that the individual that runs the daycare or owns the daycare might live on the property and be receiving a homestead deduction for that site. Next is nonprofit retirement communities. This deals with a variety of different long-term care facilities, continuing care retirement communities. It's also an exemption that has been discussed in previous legislative sessions, with the most recent language being added to House Enrolled Act 1427. And for pay 25 and pay 26, the language in the bill specifies that all or part of a building that is deemed to serve a charitable purpose is exempt from property taxation if it is owned by a nonprofit entity that is either registered as a continuing care retirement community under the applicable statutory referenced on the slide, and charges an entry fee of not more than $500,000 per unit. Or it can be defined as a small house health facility under the applicable code, or licensed as a healthcare and residential facility under the language in 16-28. Because of kind of the ongoing conversations regarding this deduction and clarifications for how it should be treated in future years, they have encouraged under a different section of the bill that the Legislative Council review and study the effects of an exemption for this type of property during the interim session. We will know if this topic has been assigned to a committee for review at the time the Legislative Council releases their assigned topics for study during the interim session. So anybody who is interested in kind of hearing the conversation or wanting to contribute to it should pay attention to the interim session calendar to see if this topic is discussed further. Next is a new exemption where 1427 establishes a partial property tax exemption for an employer that provides childcare on the employer's property for the employer's employees or certain other employees. It will apply to the gross assessed value of tangible property, and it's attributable to the property that is used for the purposes of providing childcare. It would not apply to the entire building as a whole, but would apply to that portion of the property that the child care facility or child care services are provided. So taxpayers applying for the exemption should provide necessary information on the application to help show what portion of the property is being used for child care services. Another one that was added as an exemption, it was also added under 6-1.1-10-16 is for qualified residential treatment program property. And it specifies that for pay 25 and pay 26, all or part of a building that is deemed to serve a charitable purpose is exempt from property taxation if it's owned by a nonprofit entity that is licensed under Indiana Code 31-27, and it's designated as a qualified residential treatment provider that provides services under contract with the Department of Child Services. And the last exemption we'll go over relates to quantum safe fiber network equipment. This exemption was referenced in House Enrolled Act 1601. It specifies that a county or municipal fiscal body can enter into an agreement with an eligible business that has the eligible exempt qualified property, which is further defined in our memo and statute. To qualify, the taxpayer and the lessees must invest a certain total of at least $1 million in real and personal property at the facilities for the equipment that is located in Indiana. And the average wage of employees must be at least 125% of the county average wage. So based on the mechanics of the new exemption, we'll be developing a new and separate exemption application. For those of you that are listening that are familiar with abatements, generally, a lot of the concepts that have kind of been outlined in 1601 for this exemption are very similar to an abatement. It talks about a number of employees, the wages of employees, the number of investment over time, and agreement. So because of the uniqueness of this exemption and some of the similarities with abatements, the department is currently going to have a form that is separate from the standard exemption form that applies for all other exemptions to ensure that the relevant information is captured in a way that is most useful to local units and those individuals with potentially qualifying property, and so this will be released forthcoming to be something that is separate. If anybody has an exemption that has been filed for this property at this time, you might want to hold off until the new form is available to collect relevant additional information. So at this time, I'm going to turn it over to our last topic for discussion today, which is the property tax deferral program. And covering that will be David Marusars.
All right, thank you. So I'm going to spend the last few minutes of this webinar going over a new program set up in SEA 1 for deferral of property taxes. It's a county option. The council may adopt an ordinance to establish this program for where homeowners can defer property taxes under very limited conditions. Now, there are a lot of requirements and definitions set up as part of this program. And so to kind of use as a roadmap, and perhaps I was wanting to be creative, I wanted to set this up as a kind of using some of the 5 standard journalistic questions: who, what, when, where, and how. Not why, because but why is to the property taxes. So who is eligible? First, qualified individual. Now, who is that? The starting point is anybody who is meeting the requirements for homestead standard deduction. But there are some additional requirements that are set out in the statute, but then also whatever the county council at their option may want to impose as well. First, anybody with has a qualified interest in a homestead on the assessment date for which the property taxes that are proposed to be deferred are imposed. Again, homestead follows the definition for the deduction. Now, a qualified interest means either ownership interest or an interest in a recorded contract that requires the purchaser to pay property taxes. Essentially, it's the same as the homestead deduction. However, this now says that for the deferral, you have to have a qualified interest for 5 years before applying. I must also use the homestead as a principal place of residence. Again, like the homestead deduction. However, the term in this statute, principal place of residence, is not defined, but they did add a qualification that if the qualified individual has been admitted to a healthcare facility, that does not deprive the individual of the status of using the homestead as a principal place of residence. Another requirement is the individual must not be delinquent on any property taxes, special assessments, or fees or charges included in the bill. And then must also meet other requirements that the county may choose to require, including age requirement for senior citizens, an assessed value limitation, veteran status, or income limitation. So also the deferred taxes plus any liens and liabilities on the homestead must not exceed the assessed value. Assessed value is not defined in this. So the question may come up whether you're talking about gross or net. Net assessed value typically refers to anything assessed value after application of deduction or exemptions. Since that's not specified in this statute, it's probably safe to figure that it is talking about gross assessed value here. And then also, if the qualified individual passes away, the surviving spouse can continue to have taxes deferred if the spouse also meets the qualifications that I mentioned earlier. So what is deferred? Again, property taxes, but specifically anything on the tax bill that does not include any special assessments, fees, or charges that are required to be put on the bill. Remember, however, as I mentioned previously, any delinquencies on special assessments, fees, or charges can make somebody ineligible. Now, the taxpayer cannot defer all of the taxes for any given year. It is limited to an amount between $100 and $500 per calendar year. Now, these can stack over years, but the cumulative total of the amount deferred cannot be more than $10,000 over the consecutive years. And like I said, there is the amount deferred cannot exceed the assessed value. So the county treasurer may also accrue interest on the deferred tax balance. This is accrued on a monthly basis up to 4% and begins on the date of deferral. Again, this is a may, not a shall. And as I mentioned in the previous slide, no deferral is allowed if the sum of the amount of deferred taxes plus liens and liabilities, including outstanding principal of all mortgages on the homestead exceed 100% of the homestead's AV. So where can the taxes be deferred? All of the territory within the county. Another way of looking at this is that the county council, when they adopt the ordinance, cannot target a certain spot within the county as being where homeowners can defer taxes. They oppose the ordinance. It applies all homeowners in the county can defer. So when can they be deferred? It starts with the pay 25, pay 26. The county council must adopt the ordinance by November 1st for individuals to apply to defer taxes during the next calendar year. So if a county, let's say, wanted to impose this ordinance for 25, pay 26, they would have to adopt the ordinance by November 1st of 2025. And the taxes can be deferred each subsequent calendar year until the deferral termination event occurs. That's another term that needs definition. So deferral termination event is the earlier of the date when the qualified individual either ceases to use the homestead as a principal place of residence, again, taking into account that healthcare facility exception, or another termination event is when the individual no longer has a qualified interest in a homestead, they sell it, or they it gets passed on to somebody else, or the individual is deceased, but again, a surviving spouse can continue to have the taxes deferred if they also qualify. So once the termination event occurs, the taxes must be paid within 180 days, but they can be paid at any time before then, along with any accrued interest. So there's a prepayment option in this as well. So how are taxes deferred? First, like I said, council must adopt an ordinance. Senate Enrolled Act 1 does not say this has to be done every year. So if the program is set up, if the ordinance is adopted, there is no requirement in this law that they have to do it every year. Council doesn't have to adopt an ordinance every year. Qualified individuals have to file a loan application with the county auditor in the county where the homestead is located, no later than January 15th, so the same deadline as deduction applications. The loan application has to be prescribed by the department, and applicants must also obtain written approval of any holder of a lien on the homestead and must also agree not to pay the individual's remaining non-deferred payments by escrow. Qualified individuals must also enter into a tax deferral agreement with the auditor before March 1st of the year. That is the year when the taxes are being deferred. The applicant must pay any recording fees required by the county recorder, excuse me. Once the agreement is, once the application is filed, auditor then transmits the application to the county treasurer, who then confirms that the application matches the treasurer's own records related to the homestead. The auditor then reviews the application to determine whether the application qualifies for a deferral, and as well as the amount that may be deferred. Now, if the auditor then approves the deferral again is the lesser of the amount requested by the applicant, if over $100 or $500. So again, it has to fall between that $100 or $500 amount. County auditor must then provide for the recording of the deferral in the county recorder's office. This is just what the statute says. They don't really specify what process, just says the auditor provides for the recording of the deferral. Finally, the auditor then notifies the county treasurer and the DLGF of the amount deferred. Guidance may be forthcoming on this, but for the department's purposes, potentially we could see a considerable amount of these deferrals done. And so this may be done in bulk for the department's purposes, so that we don't need to see myriads of applications kind of filed one at a time. There's also no deadline given. So again, for our purposes, as long as the DLGF receives it, that is met. And then once the deferral is approved, the applicant does not need to continue to apply for that deferral as long as eligibility is met. I see that we are over, it's now 11 o'clock, so I will try to go as fast as I can. So once the deferred taxes are made, treasurer must inform the following in the form and manner prescribed by State Board of Accounts, the auditor, the recorder, and State Board of Accounts. And the taxes are delineated by taxing district throughout the settlement process and apportioned and distributed in the same manner as property taxes by respective funds at the taxing units and in the calendar year in which payment is made. So if an individual ceases to qualify or a surviving spouse becomes qualified, the person responsible for paying the taxes must notify the auditor in the form and the manner prescribed by the department. This is the same process, the same expectation for if an individual fails to qualify or ceases to qualify for the homestead deduction. The auditor must review the information filed and determine whether the deferral termination event has occurred. And if that happens, the auditor must then notify in the manner prescribed by the department, the treasurer, the recorder, and the department. Also, the auditor must notify the qualified individuals in writing. County recorder shall also record the following without charge of the miscellaneous records, statement of the amount deferred, statement of payment of deferred taxes, and a notice of termination of a deferral. So the department, finally, the department must prescribe an application and loan agreement by October 5th, 25. Also, the form and manner of providing notices will also be prescribed in due time. So that takes care of the talking about the program. I'll turn it back over to Emily to kind of wrap us up.
Thank you, David. So the property tax deferral program, in that presentation, section of our presentation, that is one of the guidance memos that we have not yet released. Our plan is to release the guidance memo for that subject matter along with the application, as well as the form that statute prescribes us to release by October 5th. Our memo will be released prior to October 5th time, but we wanted to kind of release it as an entire package. As noted on the slide, that all of the memos that kind of go along with the material we've covered in both this presentation and will be covered in this afternoon's presentation are available on our website at the link listed on the slide. We will again also be posting any FAQ documents both here and potentially as connected to this webinar. So we encourage everyone to look at those sections of our website for additional information. I know that we've kind of, quickly run out of our time. So unfortunately, I'll turn to Jenny, but any FAQs that were submitted, we will review after today's presentation.
Thank you to Emily, David, and Stephen for giving us a wonderful presentation today. We do have a different topic, same legislative information for this afternoon at 2 o'clock. If you already had the instructions and the link for the 10 a.m. session, you will see the link for the 2 p.m. session on that same email. If you have other staff that need to attend, feel free to have them send me an email and we will get those instructions over to them. Or if you have them already, you can share those with your other staff members as well. After both of the webinars are complete, we will be sending out a link to those that were pre-registered. That will include an email, will include the presentation, the video, the survey, and the CE form. If you want CE, as a reminder, you will need to self-report that. So you need to complete the form and then submit that to the appropriate office. If you are an attorney, CLE credit is available by you filling out the survey, and there will be a spot for you to enter in your attorney number, and we will get that submitted. Unfortunately, we don't have credit applied for CPAs. If you want to contact the CPA Society to see if there are options available for you, that would be fine. But as of right now, we do not have that approved CE for a CPA. If you have any questions after this, please reach out to our legal team or your field representatives and we'll get those responded. We did get a high number of questions coming in. So as Emily said, we will get those reviewed and put out an FAQ document to answer most of those questions. So we will hopefully see you at 2 o'clock. If not, then we will see you at our July webinar. Thank you again for joining us today.